All right, so today is Wednesday, March 2nd. Recording is on. What I want to do today is just spend a little bit more time kind of practicing with the EIC and the CFI historical analysis. I also want to make sure that if anybody has any questions about homework 5 and the conversion, that I'm going to spend a few minutes just kind of going back over that and answering any questions. Right before this class started, I posted, I'll show you here, on Elms homework 6, which is going to be here in the assignments tab. And homework 6 will be basically an ROIC tree and a CFI analysis on Merck. Okay, so you don't have to do the files yourself. I posted the files. That's their ROIC, that's their CFI over 5 years. You basically have to write it up and explain it as an individual assignment, minimum 500 words. Remember, word count matters in this class. So you don't do 500 words, you don't get any credit at all. There's no partial credit. But nonetheless, those files are now posted, and that is an individual assignment. Okay, that'll be due Monday, 7 a.m. Right, and then we'll have a class on Monday. But basically, that's individual. As I said, in 2 weeks, you're going to have a group assignment where you're going to basically be doing this in a PowerPoint for another company that I will post, and then you'll work on that as a project team and then explain that as well. Okay? And again, 1 week from today, just as a reminder on the logistics side, Bloomberg is coming. So they're going to be here all day. I talked to them yesterday. And again, they're going to spend about 20 or 30 minutes on recruiting. One of the things that they confirmed is they actually still are looking for both interns and full-time people this year. So if you're still looking for a job, they're going to be here to help recruit. And as I said, they specifically recruit out of this class, not just the University of Maryland, this class. And so this is a real good opportunity if anybody is actually interested in that. The other 30 or so minutes is they're going to do some advanced terminal training. So that's what they're going to be here next Wednesday, all sections. So please take advantage of that. Okay. So with that in mind, just want to talk briefly. I'm going to go back and talk about the conversion first. So we didn't really spend a lot of time on this on Monday. So let me just open up this file. Let's share. All right. So this is homework 5 version of the solution. Now with the solution file, I actually don't post the formulas just because over the years, people have taken the solutions and turned them into a solver, which they sell. And that is a clear and blatant honor code violation. So using a solver is definitely not allowed, but I'm not trying to make it easier to do the solvers. And what I mean by a solver is they have a kind of a pre-done Excel file. They type in numbers and auto converts for you. Everything is mapped. So if you happen to stumble across one of those files, you use those, you're going to find yourself in front of the honor council. So you're not allowed to use solvers in this class, just to be really, really clear. All right. So basically, when you did the conversions, you would have started with these financials. And the first statement that you would have converted, TII, TFI, start out with TFI, is an easier one. But what was easier about this conversion is you lump together all of the ones, okay? And then you just net them, all the assets minus the liabilities, to get what's called operating invested capital. Now, in the solution, I did go one step further. And it's not necessary for what you did for your homework 5 work, but going forward, you're going to see just things put together in this format where operating invested capital was the number that we're going to check for your grade. But I did break out the invested capital into what's called working capital and long-term capital in the solution. Okay. And the reason why I did operating capital, long-term capital broken out in the solution is that when we do the valuation forecasting in the next module of this class, working capital and long-term capital don't grow at the same rate. So we're going to break them out so that we can forecast them to grow at different rates. Okay. So nonetheless, you take, if you're following this methodology, all of your operating assets that are ones, all of your operating liabilities that are ones, bundle them together, net them out. That's called operating working capital. Same thing, all of the long-term assets that are ones, all the long-term liabilities that are ones, net them out. That's your long-term capital. Working capital plus long-term capital equals operating invested capital. Okay. This one should have been easy. I think most people probably got this. Same thing though works out if you're trying to do TFI. Basically, you take all your twos, those are the 3 twos, you kind of lump them together, assets, liabilities, net them out, non-operating capital. Operating capital plus non-operating capital, TFI, right? Then same thing with debt and equity, take all your 3s for debt, take all your 4s for equity. You can kind of sum your 3s and 4s. That's your TFI. TFI balances. Okay, so that should have been fairly straightforward. The other thing is you're doing the same thing with the income statement. All right, again, I told you a shortcut. You could have taken the operating part of the income statement was EBIT, because everything above EBIT would have been operating. Then we break out the taxes to each of the individual areas. So using the tax rate, which in homework 5, I believe was 30%. Then basically you take 30% of your EBIT, that's the tax on EBIT. So the whole point here is if this was just our profit, we didn't have any debt, we just had earnings before interest and tax, what would we owe in taxes? That would be the tax on the EBIT. And after that, we get our no plan, EBIT minus tax on EBIT's no plan. Okay. And then we went through the non-operating section. Non-operating, these were our 2s. I had interest income and a non-operating gains and losses. 30% of that is the taxes of the non-operating income. 30% of that will be the tax impact of the non-operating and the interest income. 30% on the non-operating income. Net those out, add those up, after tax non-operating income. Now I noticed a few of you lump these together. Like you could have taken interest income and non-operating income, instead of having 20 minus 6 equals 14, you could have had 20 plus 24 is 44, and then taken 30% of that, and you'd have still gotten the same answer, right? So if it was easier for you to lump them together, fine. I broke it out more granularly just so you kind of get a sense of what is going on, right? That equals your non-operating income plus no plat, TII, right? And again, that's going to be balanced by interest expense. Again, the tax shield and the interest, after-tax interest expense. Minority interest is already after tax. Like one trick is that, and I'm not going to, this is pretty common, but everything below EBIT, interest expense, interest income, is going to be pre-tax until you get to taxes. And then when you get down to taxes, everything after taxes on an income statement is after tax. So minority interest is after tax. Net income is after tax. Okay, so you don't have to double tax the minority interest because taxes have already been taken out. Right. So that was the minority interest payment, which is basically a dividend on the interest on the a dividend to the shareholders on the income statement. So that was already after tax. You didn't tax impact that again. Net income is after tax. That's where the income statement starts. Add these 3 up, you get your TII. TII should balance. Those were the first 2 statements. Those were the pretty straightforward statements. Questions about the first 2 statements? The third statement was the CFI. This is the one that probably gave you more trouble. And so again, in the operating section, it's just kind of following the format. It's gross cash flow, which is cash for the income statement. So no plat plus depreciation. And then gross investment. Now, there were 2 ways you could have done gross investment, right? The first way, which is probably the way you did it, was the more granular way, which is just change in invested capital plus depreciation. That's the method I introduced in class. What I'm showing you here is that This also equals the sum of everything above it on the balance sheet, meaning if the change in the working capital, so if you go back to my TFI, because I broke out working capital separately, if the change in this, the operating invested capital is the change in the working capital, and then the change in each one of those line items below. Okay, so I just did it more granularly here, as opposed to just doing the overall sum here. Either method would have been fine for homework 5. Okay, but the more granular approach that gets you the same answer, this is the change in working capital. And then the change in net PP&E is called capital expenditures, right? Now, in this case, what I've done is I've solved for capital expenditures. Formula's over here on the right. I know that on a balance sheet, if I begin my PP&E plus my capital expenditures, subtract my depreciation, I get my ending PP&E. It's kind of how a balance sheet works between 2 periods. So I'd explain the change in PP&E between 2 periods. That's the formula. So rearranging this formula, I know that capital expenditures has to be my ending PP&E minus my starting PP&E plus the depreciation. So in this case, I've just solved for CapEx. I didn't use the CapEx that the company gave me. I just solved for the CapEx, right? And then change in goodwill, change in long-term liabilities, net them, that's gross investment, okay? Now, by the way, in case you're wondering why this formula is change in invested capital plus depreciation, you might say, gee, where did that plus depreciation come from? You can actually see it right here on the CapEx line. Like change in CapEx is change in PP&E plus depreciation. Every other one of these line items is just the change in the asset or liability. The one difference is net PP&E is change, which is CapEx. The change is change in net PP&E plus depreciation. When you sum all this up, it's change in all the asset and liabilities plus depreciation. That's actually why the shortcut is change in invested capital plus depreciation. Gross cash flow minus gross investment is free cash flow. Non-operating cash flow, again, income statement items, change in balance sheet, repeat here to get the non-operating cash flow. Operating plus non-operating cash flow, CFI. The final part is, this is probably where most of you had trouble. I told you there were 2 tricks in the CFI. Trick number 1 was debt was pretty straightforward for the 3s. Interest expense, change in debt. Equity would have been the dividends, not the net income. And minority interest is a dividend. Preferred dividends is a dividend. Common dividends are a dividend. So again, here you're using common and preferred dividends. You're not using net income. So net income is not part of the cash flow statement. It was part of the TII. So that would have been the first thing that could have tripped you up. And then it's change in all the stock categories, equity categories, except you don't put, you leave out retained earnings because that's a non-cash account. So it's all those equity categories except for retained earnings. So it's changing those accounts. When you add all that up, you should have gotten a CFI that balanced. I'm going to pause. Questions? Statement number 4 would have been economic profit. Again, on the homework 5, I told you use beginning of year ROIC. So if you use the spread method first, put your no-plats out, put your invested capitals out. Current year no-plat divided by previous year invested capital is beginning of year ROIC. I gave you a WACC. ROIC minus WACC is spread. Spread times capital is invested or economic profit. Method number 2, no-plat less capital charge. We talked about capital charge as cost of capital times starting capital. No-plat minus capital charge, balancing economic profit. 2 methods, simple statement. What's important to know is that for both of these years, we start to do analysis. This company didn't create value, even though it had a positive profit. even though it had a return on investment that's positive. Because the return on investment was less than its hurdle rate, it destroyed value. This is how much value it destroyed each year in dollars. That's the difference between the 4.9% and the 6%. That's what economic profit, also known as economic value added, is ultimately all about. Somebody's asking in the chat, do we have to do one method for economic profit, or we need to do both and make sure the same? Both, make sure the same. All four statements have to balance, which means both methods, all statements. If you only do one, it means you didn't balance it. You don't know that you did it right. That is the approach that I take in this class. The problem with an unbalanced statement, the problem with not doing the other side, is you can make a mistake and then you won't know. When you balance the statements, you know you're right. So in this class, an unbalanced statement, not having the two sides balance, is an incorrect answer. Even if one of your answers is correct, it doesn't matter, because as I said, when I introduced the statements, you don't know that one of the two numbers, if you have different numbers on both sides of the statements, if you have two different numbers, you can't tell me which one with certainty is correct. So therefore, it's an incorrect answer, even if one of them is correct. Same thing. If you only do half the statement, you don't do the other half, you don't know that you did it right. You can't show me you did it right, even if you have the right answer. Therefore, it's an incorrect answer. Therefore, you don't get credit. That's a standard in this class. Personally, I believe it should be your standard in the real world, but people get lazy. In the real world, they don't balance statements. In the real world, they make mistakes. Here's less likely to make a mistake in the class as you're learning how to do this stuff. All right, any other questions about any of this? All right, I want to go back to the first tab. So the other thing I wanted to show you on the TFI is this. I told you once we convert the statements, we'll then be able to do analytics, right? And I also wanted to show you the difference between, as I said, what you learn is ROIC in the rest of the world, what they call ROIC, what Bloomberg calls ROIC, and what we're calling ROIC in this class, and what the difference is, just looking into the simple company. So here is Bloomberg's definition of ROIC. What Bloomberg would do is it would take what we would call total income available to investors, and it would divide total funds invested. And that's what Bloomberg calls ROIC. Because Bloomberg and the other academic books that you experience, and to some degree, most people in the real world, they don't distinguish between operating and non-operating performance. They just take the total profit and they take the total investment and they just divide. So it's an average ROIC. Okay. What we're going to do this semester is, you can see up here, we're going to do an operating ROIC. How is that different? TII, we have no plat. TFI, we have operating capital. No plat divided by operating capital is operating ROIC. On the TII, we have non-operating income. On the TFI, we have non-operating capital. Non-operating income divided by non-operating capital is non-operating ROIC. When you put these two together, you get the average. Now, in this made-up company for your assignment, there's virtually no difference in 2017. Who cares? But in 2017, it's a different story, or 2018. The next year, this made-up company, the operating ROIC is 5.8%, but the non-operating ROIC fell to 3.1%. There's a big difference, right? It's 5% average. But here's why this would matter. If this was then our perpetuity period in the real world, we get a different answer for valuing the firm with a near 6% ROIC going forward on their operations versus if we put it down to 5%. Okay, those are two different answers for valuation, right? And what I'm telling you is, if I'm trying to understand the operating value of the firm, what it makes with its operations, because that's the point. The whole reason why we call this operating invested capital is this is what they use to make their products. This is what they use to deliver their services. And every time they sell a product or service, this is the stuff that would have to be recreated, more money spent on. This stuff has nothing to do with sales. As I said, because we can do NPVs, we value it separately and add them together. But that's the whole idea, value separately. This has a separate value than this. And the reason why is because the returns on operating and non-operating are not always the same, and they don't grow at the same rate. And that, to be honest with you, is the most important insight I can give you about valuation from this class. That is the difference between McKinsey's approach and the approach of almost every other financial firm on Wall Street, is they don't break it out. Most people just do the average. You're taught the average. You're taught the average in school. You're taught the average in the real world. Heck, Bloomberg even delivers an average every day as their default metric. All right. So what I'm giving you is a little bit more nuanced and to some degree more advanced. All right. But that's what we're going to do in this class, because we're going to get better valuations because of that. All right. That's the conversion. As I said, I'm going to post right at the end of this class another conversion. It's not for a grade, but we're going to talk about it on Monday. So it's just practice. Okay. But I strongly encourage you to practice on the next conversion, because when you get to your midterm exam 2 weeks from today, you're going to get something that looks a lot like this, but it won't be for practice. It'll be for 10% of your semester grade. And so the only difference between this and the homework is you'll have 90 minutes to do it. And so you'll take the midterm during class time on Monday, March 16th, which is the new shifted time of the midterm. And so you won't have to come to class that day. I'll make the midterm available at the beginning of your class, and you'll have to submit the Excel file converted by the end of the class. The only other key thing that matters to that midterm is you're going to take it during your class time. So if you're visiting from an earlier section today that I didn't have, and you're in the 8 o'clock section, you'll take the midterm between 8 and 9:30. If you're in the 12:30 section, which is the one right now, you'll take the midterm between 12:30 and 2. I'll give you that 90-minute period to do it. All right. But at the end of you won't be able to take the midterm out of your section. You have to take it during the section you're registered for and during the time that you're registered for. You just won't come to a live class. You'll just go to Elms. The file will be available. You download and submit before the end of your class period ends up. And if you submit it after your class period ends, you don't get any credit. Right? So that's your midterm in 2 weeks. So take advantage of the practice files that I'm going to post, because what I'm going to post is a historical midterm. I'm going to post as a practice file a midterm that we used a couple of years ago in class. All right. So you can practice using an actual midterm to see what's coming up. On the midterm, somebody's asking in the text, will the labels be here? 1, 2, 3, 4? Yes, they will. All right. So I'll give you the labels on the practice file. And the practice midterms can be a lot like the exact midterm. You'll just have different categories and different numbers, but it shouldn't intimidate you, because essentially it doesn't matter how many categories I give you. If you know what the label is, 1, 2, 3, 4s, you know how to put things in there, and you just net assets against liabilities and follow the process. Okay. But nonetheless, it takes practice to do this. So I'm going to give you the labels through the midterm. That's why I'm going to give you a practice midterm today to practice for next week. Okay. What day is the midterm again? It's 2 weeks from today. It's Monday, March 14th or 16th. Monday, March 16th. Originally, it was going to be March 9th, but then Bloomberg said that the only day they could come was March 9th. And I think it's more important that they come and we have access to them, particularly for the recruiting side. So basically, I moved the midterm to Monday, March 16th.
The 16th is a Wednesday. I just want to make sure it's that Wednesday.
Sorry, take it back. I can't do my math. I keep thinking today is Monday. I've lost complete track of time. So my apologies.
No problem.
Erase everything I told you. And the midterm will be on Monday, March 14th. So the midterm is on Monday, March 14th. Okay. But, and that's why I think I had the 16th in my mind. The 16th, which is the last class before spring break, is basically going to be the group project presentations for group project 2. So group project 2 presentations, March 16th. Midterm, March 14th. complete last close time. March 9th, Bloomberg visits. March 7th, we do all that prep and answers. And then you go on spring break. How time flies in the first half of the semester. The other thing that happens on or about March, just as a reminder, since we're talking assignments, on or about, when does Bloomberg Trading Challenge ends? March 14th, the Bloomberg Trading Challenge first half of the semester ends. So that's the other thing that is coming to an end in the first half of the semester. And just as a quick check-in, because we're now 12 days away for the trading challenge ending, let's see how we're doing. Share screen, Bloomberg. All right, so again, idea or team message. This is section 401. All right, so the good news, everybody's made at least 10 longs. And the good news, everybody has under $300,000 of available cash. The bad news is the market's been pretty tough, but to be honest with you, here's two teams that actually have a positive return in a tough market. So, I mean, that's actually pretty good overall. As a matter of fact, Bloomberg, and I know we don't really talk about this, but Bloomberg also tracks not only how you're doing, but they track what they call a relative P&L. And so what the relative P&L is how your portfolio is doing against a market index. So if you actually just invested in the marketplace, you would have made, you made $44,000 more than if you had just invested in the marketplace. So given how brutally tough the market has been, this team's actually done pretty well. Not only have they made a positive 3% return in a terrible market, they've actually beat the underlying indexes over that period of time by about $44,000. So that's about 4%, because the actual markets would have been down 4% when they're up 3%. So overall, you know, you guys are all actually doing relatively well compared to the market. It's a tough market, but nonetheless, this is the ranking. And so if the trading challenge were to close today, first place team gets 5 points, 4 points, 5 4, 3 points, 2 points, 1 point. Okay. But the trading challenge doesn't end today. You still have another 12 days. Questions about the trading challenge? All right. Then I want to go back to our lecture notes from Monday, where we talked about Starbucks, we talked about Target, and we talked about Walmart right before the break, but we didn't get to Costco. And so I want to do one more practice today on Costco. This is in lecture note 4. So here's what I'm going to do. I'm going to put you into teams, random teams, in breakout rooms, in Zoom for 10 minutes. I'm going to get you guys a chance to kind of practice walking through the ROIC tree for Costco and walking through the CFI for Costco one more time. And then when we come back in 10 minutes, I'm going to call in some volunteers. And you're going to explain to me and give me the walkthrough for the ROIC tree and the CFI. Okay. As a reminder, when you do the ROIC tree, you have to cover both sections. You got to talk about all 3 of these: tax rate, margin, invested capital, sales. Then you have to talk about what drives margin, these 3 drivers, what drives capital, these 3 drivers. Same thing, when you go through CFI, you got to cover all 4 sections of the CFI. Okay, so don't just give me highlights, all 4 sections, both levels of the tree. All right, you guys have a copy of lecture note 4 already. Those were the last 2 slides. So I'm going to put you, as I said, into teams. And I will see everybody in 10 minutes. All right, welcome back. So let's talk about Costco CFI or ROIC tree during this period. So all the teams talk, let's pick a random team. Team 9, room 9. That team, it's like Ian, Lily, Margaret, Ryan.
Yes.
So I'll give a chance for one of you to get started. First level ROIC tree.
So overall, the ROIC increased by 18.5%, and we broke it down by looking at the end of year pre-tax ROIC and the cash tax rate. And I think both of those factors contributed to the ROIC going up because actually, yeah, so the pre-tax ROIC went up by 1.9%, but if you look at the cash tax rate, it went down by negative 32.8%. So that was a big factor with why the end of year ROIC for Costco increased. And should I go on or?
Sure, but just to stop you. So when you say the Costco increased, I don't know the sense of the magnitude. What numbers are you talking about?
So from 2015, the end of year ROIC was 18.9%. And in 2019, it was 22.4%. And that was the 18.5% increase.
Okay. Because I'm just saying, when you say ROIC went up, you could have been talking about 2016 to 2017. You could have been talking about 2017 to 2018. You could have been talking about 2018 to 2019. You could have talked about 2016 to 2019. See, that's the problem. When you don't use numbers, you're looking at something. It's obvious to you what you're looking at, but it's not obvious to the person that you're talking to that you're looking at. And I'm just letting you know, this is why I harp on this so much, because it gets hard to follow. So much better when you gave me the sense of the numbers you're talking about. So you guys, you're doing a good job and keep going.
So just like, which component should I go over?
Well, you're doing the first level drivers. There's 3 of them. I only heard one.
Okay, so for the second level,
You're on the first level.
oh,
There's 3
okay.
on the first level.
All right. Should I like just go through all the years? And so like the pre-tax ROIC is a driver for the end of year ROIC. And in 2015, the pre-tax ROIC was 28.2%. And in 2019, it was 28.8%. So it was actually only a 1.9% increase. So it slightly contributed to the end of year overall ROIC for Costco increasing. And another driver for the end of year ROIC is the cash tax rate. And in 2015, it was 33.2%. But after a few years in 2019, it was 22.3%. So over the 5-year period, it actually decreased by negative 32.8%.
All right, just so I can stop you right there. So you just read a bunch of numbers. Which of those 2 drivers had a bigger impact on the change in the end of year ROIC from 18.9 to 22.4?
The cash tax rate, because the magnitude was bigger.
That's another insight I just want you to also say. Because like I said, you just start reading numbers. 28.2 to 28.8, 1.9% increase. 33.2, 22.3, 32% decrease. Let me move on to the next number. Okay, you're just reading numbers. So help me connect dots as you're reading numbers. Cash tax rate's why it went down. The pre-tax rate was flat. It really didn't have an impact on their after-tax ROIC during that 5-year period. Make sense?
Mm-hmm.
Okay. Just to pick on somebody else, so thank you for getting us started. Why did the pre-tax only go up 1.9, and did anything about the underlying next 2 drivers change? Team 2, Jack, Jacob, Matthew, Robert.
I can talk about it. So, the pre-tax. Sorry, let me just get into. So since the operating margin from 2015 to 2019 fell 0.5%, that hurt the pre-tax ROIC.
Okay.
But the fall in invested capital over sales had a larger positive impact of negative 2.4%, which shows why the pre-tax ROIC increased 1.9%.
Okay.
Do you want me to keep going into like operating margin?
Well, you had a good start with linking that. Would great if you used a couple of the numbers there, other than the change in percentage change. But other than that, great job getting started. So yeah, keep going.
Okay, so we're looking into the reason operating margin changed. So we can attribute that fall in 0.5% from the fall in the gross margin of 0.3% and the increase of depreciation of 0.7%, which both have negative impacts on the operating margin. While SGA falling 0.3% should have helped the operating margin, the other two changes outweighed this due to the higher magnitude. And then going into the invested capital over sales, the operating working capital over sales large increase of 31.2% over 2015 to 2019 negatively impacted the invested capital over sales. The PPE over sales increase of 3.2% also attributed to this negative effect, and as intangibles didn't have any change because most likely no companies were acquired during these times. Just this operating working capital over sales and increase in PPE over sales were the reason for this fall in invested capital over sales of 2.4%.
Okay. Great. No, that was pretty good. So as we look at all of these numbers for Costco, does anybody notice something else that's kind of interesting about Costco's totality of numbers and changes? It's kind of looking across the years. What do you notice about Costco with those numbers?
For the most part, they're very steady.
Yeah.
Costco is almost like a clock. So you're exactly right. And that's actually one of the reasons why investors like Costco, because there's almost no deviation. Just look at their operating margin. I mean, 3.1, 3.1, 3.2, 3.2, 3.1. They have a very consistent margin on their products over time. They have a very consistent level of productivity. If nothing else, it means they're fairly predictable. So it's relatively easy to model out a Costco in the future because you're probably going to model out about a 3% margin and you have a pretty good sense of what their spending is. And so it's an easier company to do it. This is also why companies like Costco tend to have lower hurdle rates because they're going to have lower betas because they're more predictable, right? But you kind of get a sense of that even as you're going through this ROIC trade. Okay. Far different than what we saw when we started to look at a Starbucks. Starbucks was almost like a roller coaster, right? All right, let's go on and talk about CFI. So to get us started, here is the Costco CFI that you analyzed. Why don't we go to room one? Benjamin, Karen, Longfee, Peter, Sahil.
We didn't really get to this part yet, but I can like kind of take a stab at it.
Okay.
Okay, so in starting with the free cash flow, we can see that again, over the years, apart from 2016, that their numbers are relatively steady. So linked to 10,961, and looking down, to the cash flows available to the investors, those numbers were a bit less steady. And I think, in looking at it, there was a decrease in excess cash, which contributed to that, and also a really small increase in net non-operating assets. And then moving forward.
All right, I'll stop you right there. So if you had to self-assess your grade on this one, how do you think you did so far?
Terribly,
Why?
because I didn't link the numbers together and find the trends and
Yeah.
also use specific numbers.
Okay, at least you know. But yeah, that would be that's why it's also important to do numbers. Like, even if you haven't really done the analytics, kind of walking through the numbers will help you as you kind of work through the process. So just to be fair, I'm not going to let you keep going. So let's pick on somebody else to kind of pick up from here. So how about team 5, room 5, Callie, Cindy, Mark, Sawyer, William? Need an assist from one of you. Go back to free cash flow and walk us through the elements of free cash flow on the CFI.
Sure. Yeah, I can walk you through the free cash flow equation. So I guess looking at just go annually, we'll just start with 2015 here. So you're going to have your NOPAT of 2,422 million. And that's just EBIT times 1 minus your tax rate. You're then going to add back DNA because it's a non-cash expense. This will take you to your gross cash flow. There was a decrease in net working capital between 2014 and 2015, which pretty much just means that the change in assets was higher than the change in liabilities. And then you have to add back CapEx of 1698, and then add up gross investment, and then that will get you to your free cash flow excluding goodwill. And then any investment in goodwill and intangibles, there doesn't seem to be any M&A activity that would result in a increase to this account. That would then get added there as well, but there wasn't. And that takes you to your bottom line of your FCF.
Okay. So thanks for helping us understand structurally how that all works as well. So just looking at the total columns, jump over to the far right. So how'd they get to 11 billion of free cash flow?
Throughout the 5-year historical period.
No, just looking at the total. Just focus on the total. How they get to 10,961?
Yeah, so like walk through that equation again, or
You have to walk through the equation. Just kind of give me the key highlights that got it to 10,961.
yeah. So their operating income of 14 billion, 14.4 billion. They had a DNA on their on their total or their capital assets of 6.6 billion, and that got them to 21 of their gross cash flow. Looks like they had 12.7 billion in capital expenditures, which is just any capital investments that have a lifetime of over a year. And then another notable item would be that reinvestment rate, which jumps around throughout the historical period, but I guess averages out to about 48%.
All right, but just to be even more granular, in the total, how much reinvestment did they make over the 5 years?
48%.
Yeah, which was the 10.2 billion dollars.
Yes.
So basically they put 10.2 billion back of the 21.165, and that's how they ended up with the free cash flow of the 10.9.
Yep.
Just want to make sure we're connecting those dots.
Oh, gotcha. Yeah, sorry.
Final question. Because like I said, it may be obvious to you, but when you're making these presentations, when you're doing these write-ups, I want you to help it become obvious to the grader, to the reader. Make it obvious to me. Okay. And this was said, I don't need you to redefine all the formulas again, but I do need you to kind of tell me how these things kind of play out. Here's one other one on the free cash flow. What is the signaling impact of growth for 2020?
Though, sorry, what impact of growth
Signaling impact of growth for 2020.
for 2020? The signaling impact of growth. I would say, I guess that EBIT has been growing steadily over the historical period at about
That's not the number. Sorry, that's not the number. I saw, all right, Xavier, you're raising your hand. You're going to give him an assist.
There we go.
Yeah, so the increase in capital expenditures is a signal of growth and trying to grow into the future. So from after 2015, they steadily spent over $2.7 billion in capital expenditures, hoping to grow over those years.
Okay. So, but there's one other insight we want to connect the dot to that I mentioned on Monday. So it's if you look at 2019, yeah, Omalola.
Yeah, that's right. We're looking at the CapEx over depreciation for over 2015 to the total for every year. For example, in the total, the 12 billion over 6 billion, that's almost a 200% ratio. So that signals growth.
Exactly right. And they're continuing to expect some growth even in 2020. Right. So that's the insight for growth that we could also pull out of this. So since you did such a great job on answering that one, Omalola, can you go to the non-operating cash flows that got us to the CFI? So how did 10,961 turn into 10,054? Anything happen in that non-operating cash flow section?
Non-operating cash flow. Yes. So in the total column, we can see that mainly the increase in excess cash, like the 13 or 1.3 billion, caused a decrease from the free cash flow going to the CFI of 10 billion. The foreign exchange losses, gains, the non-operating gain loss, and the after-tax interest income did have somewhat of an impact, but of like 83, 59, and 245. But I'd say the 1.3 billion increase in excess cash was the biggest driver that left the CFI as a slightly less free cash flow, going from 10.961 billion to 10.051 billion.
All right. I have to say, great job. If this were a transcripted video and you copied and pasted and typed this in with a reference to the video, that would be a great answer on your paper. So good job. That's exactly the way to think about that section. All right. So let's see if somebody else can follow that act. So how about team 6? Chen, Emma, Scott, Ucha, go from 10,054 to the distribution. Tell me about the financing flows.
Yeah, I can go it.
Go ahead.
So on 10,054, like a large part of it was given out in common dividends. And then also a large part of it was used in share repurchases. And
when you say a large part, I don't know what you mean.
oh, sorry, I forgot the numbers. So of that 10,054, a lot of like 9,000 of it, 9,242 billion was used to pay common shareholders.
Okay.
And then 2 billion was used to buy back shares, to do a share repurchases. And it may seem like 11 billion, but that 11 billion was then offset by the increase in the increase in debt. So debt increased by 1.7 billion, And then also that increase was offset by share issue of 0.2 billion.
Okay. So basically they borrow that debt, as you're kind of helping to explain, because that's how they got to the 11 billion of dividend and share repurchase. Because they only had 10 billion to pay. They needed to borrow the debt to get to the 11 billion.
Yeah.
Okay, good. Thank you for connecting those dots. Now, again, as we just went through this, we went through the totals. So we still want to kind of look at some trends over time. And so the key to the trend is, okay, free cash flow. What do we notice about free cash flow? Well, what we notice about Costco is that their gross cash flow was consistently growing year over year. Went from 3.5 billion to 5.1, right? The one thing that didn't grow year over year was the gross investment. That kind of bounced around. It started at 29% in 2015, peaked at 105% in 2016, and then it averaged 48% over the 5 years. In 2019, it was more like an average year of 45%. Okay. As we look at the debt and equity cash flows, again, the common dividends, they jumped in 2017. Okay. So they spent a big number, 2865 in 2015, and another big number, 3904 in 2017. So typically when we see dividends, we see a consistency. Companies don't usually jump them up and then jump them down. This is a little different. So if you might think to yourself, why? If this were your group project where you have 7 people working on this for 2 weeks, then I would have expected somebody to look that up. Okay. And explain, like, why is Costco's dividend bouncy? That's not something normally we see with companies. As opposed to, for this assignment, just noting that there was some variation in the dividends over the 5 years. So again, it's not every number over 5 years, but kind of highlighting key trends amongst each of the sections. That's what you need to do for your individual assignment that's due on Monday. Okay. So make sure when you walk through the ROIC tree, you walk through, again, both levels. Level 1, explain using numbers. Tax rate, margin, invested capital sales that changes the ROIC. Then what drives the margin? Walk through the income statement drivers. What drives the productivity? Walk through the balance sheet drivers. Use numbers along the way. CFI, start with, as we just did in class here today, start with the free cash flow. How did I get to the free cash flow? How did I get to the CFI? How did I distribute the cash? Right? That's what you're going to structurally be writing up individually for Merck for your next homework. So sitting here on Elms, is under assignments, homework 6. I've given you an ROIC tree and a CFI for Merck, 5 years of historical data through 2020. That's what you're going to write up, approximately 250 words each, but there's no maximum word count, just minimum word count, due Monday. The other thing I want to highlight is I did put up here under files 2 practice midterms from historical years. There's a practice midterm. And by the way, there's the solution to the practice midterm. There's a practice second midterm. There's the solution to the practice second midterm, right? These were real midterms, similar to the one you're about to take. And basically, they have the labels, the 1, 2, 3, 4s. Okay. My strong recommendation to you when you go through these practice midterms, don't look at the solutions. Try and do it without looking at the solutions first. Okay. If you get stuck, you can go look at the solution. But nonetheless, you got 2 more conversions to practice. This is what your 10-point midterm exam is going to look like a week and a half away. It's going to be one of these. You'll have 90 minutes to do it. Just different numbers, different categories, right? Questions about any of that? All right, well then stay safe out there and we'll see everybody on Monday. Have a good rest of your week. Remember, TAs have office hours.
Thank you.
Thank you.
Yeah.
Bye-bye.
Thank you.